Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is October 9th edition of Weekly Market Outlook. All right, let's get right into the details here. First of all, in terms of volume, what we can see, we've got increased volume this Friday on a down day. That gives you a really strong distribution day. Now, more importantly, if we can see what's been happening here is there's been real deterioration. We only have one accumulation day over the last 2 weeks, 4 distribution days. That's definitely showing you signs of institutional distribution. Across the board, you can see the number of distribution days across all of our indices versus accumulation days much, much higher. So even though we had what I would call a relatively mild downside week across all 4 indices, the volume patterns are definitely a bit more concerning. So let's take a look at what our sector tables are telling us. Well, first of all, one of the things, of course, we like is to have uniformity and great performance across all of our sectors. And one of the things, the way we measure it, is we look at the 6-month performance of each of the sectors. And so we've broken it down to 14 sectors. You can see when the market hit basically the highs, right, in July and August, all sectors had positive 6-month return. What's now happened here is we've dropped down to 9. So even though it's overall a positive, there's been some severe deterioration. Let's see where that's happening. Well, a couple of things. Utilities, which was our leading sector up until recently, or one of the leading ones, has really gotten hit hard. You can see down 9% over the last 3 months, and now its 6-month return is negative. Okay, so interestingly enough, generally, lagging utilities is a good sign, especially when the S&P is doing well. So that's not so bad. But what is interesting is that home builders and real estate really got hit. Not all that great. So that is on the negative side. Number of sectors, positive, definitely dropping off. Now, on the positive side, look what happened here. Our leading sector, semiconductors, actually put in a positive week, bucking the overall trend. So that's a positive sign. So even though you've got this negativity down here at the bottom of the table, it sort of overweights the one sector that's done well. And of course, you did okay with the financials, but not enough to offset the overall deterioration here in the sector view of the world in the market here. So let's take a look at market hotspots. The leader this week, outstanding performer, sort of coming alive once again, has been natural gas, and also one of our holdings in our ETF complete model. Another interesting commodity that's been on the move very strong has been sugar, right? Lagging, obviously the thing that's been putting pressure on quite a bit of the world's instruments has been the British pound. So the dollar got really strong. Gold, which is not showing up here, got hit really hard. And as a result of the strength in the dollar and some strength in U.S. treasuries in terms of interest rates going up as well. So it's sort of inverse. But again, key thing, energy doing well, led by natural gas, a little bit of action in some commodities, and the pressure coming in from the British pound. Let's take a look at the market internals here. And as you can see, continued deterioration. Now, what's interesting is all of our indicators, our 5-day up-down, crossed the midpoint, turning down. Our McClellan oscillator, which looks out over the 2 to 3 week or 1 to 3 week period, a little bit longer term than some of the shorter term numbers here or indicators here. The 5 and the 10-day are a little bit more sensitive than the McClellan, which looks out over a longer term period. So McClellan definitely deteriorating and passing well under the midpoint. But look, none of these indicators are oversold, so momentum is clearly to the downside and has weakened. But we are not clearly oversold, so potentially there's more there. Let's take a look at our next chart, which is the NASDAQ. You got a really similar picture in NASDAQ with the market internals as well, right? We just crossed under the midpoint on our up-down volume. Same thing with our advanced declines. And we've been sort of hovering, trying to test the midpoint in McClellan, and it turned down pretty decisively on Friday. Now, the big difference between the composite and the S&P, excuse me, is the fact that the NASDAQ stocks are much stronger and in a pretty good position because we're stacked and sloped in terms of the moving averages, which is great, and our position is sitting above all the moving averages or pretty much right at the 10. So overall, our position in NASDAQ quite strong, which is different than the S&P, which I'll get back into in 1 second here. Let's take a look at the new high, new low ratio. Again, overall in the S&P, pretty positive. And what I wanted to show is this right magenta line here is the 50-day moving average, and the green one here is the 10. So we're sitting under it. So you're in a warning phase in the S&P. Here's a key number to watch. 213.70 would break this wedge. 213.65 to 70 is the critical number, right? It would take out all of this. As of Friday, we closed at 214.91. So again, we're not that far away. Now, on the contrary, a move back above the 50-day moving average and the recent highs here would be extremely powerful. That's about the 216.80 or 216.70 level. So again, this compression is definitely going to power a substantial move either up or down. And with the information you're looking at here, it's pretty mixed as to what's happening, right? Some of the internals are pretty good. Some of them are definitely weakening. So you've got this mixed bag, and you've got this very strong NASDAQ market and a tenuous S&P. And that is the scenario that we're in. Let's take a look at the, some sentiment indicators. By the way, this is the new high, new low ratio. Again, we're over the 70 level, flip back up. So again, NASDAQ positive, although we hooked down a little bit, I still put this in a positive camp. All right, so now let's take a look at sentiment. Sentiment, you can see we're trading in between these blue lines here, which is Bollinger, under the 200 and basically right at the 50-day. Sentiment is not frothy at all. It's sort of in the mid-range. I look at that as a positive. And as long as we're basically staying under those key moving averages, we're in good shape there as well. And finally, the relationship between short-term volatility and long-term hovering just above the 1.2 level. Again, if the market starts selling off, you're going to see, you should see this particular indicator start trading under the last month's worth of action, which is 1.2, and that's something that would be confirmation of a potential downside move. But in the interim, we're trading in a positive overall scenario where sentiment is looking not too frothy. It's strong, but not overdone like we saw up in here at extreme levels before we got the sell-off. So that's where we are at the moment. So hope this helps. See you next week. And certainly we're in interesting times with this election. And again, market can go either way here. Not much of an opinion other than that the compression that's occurred over the last month and a half should power a pretty good size move. And it could happen before the election. Thanks.